Despite the recent record highs in the stock market, there are plenty of sectors that have failed to keep up. Michael Gayed of Pension Partners is Skyping with us this morning to tell us if some of those may be good places to park money. Good morning, Michael.
Hello.
Let's start with the bond market. Good time or bad time to go long on bonds?
I think bonds in general have probably overreacted to this fear about Fed tapering, a pulling back of quantitative easing, given that inflation expectations are still relatively muted. And given that really a lack of demand pull and cost push inflation, jobs are not picking up in a very accelerated way. Commodity prices are not rising, suggesting that you're not going to see inflation push through to the consumer. So it's hard to see how the Fed can really step back too aggressively. Now, that probably means there is an opportunity a little bit longer end in the curve, but every single time that the Fed has tried to step away from stimulus, they've had to come back in. I suspect you're going to see the exact same pattern.
Gold has lost its luster. Would you get in or get out here?
Gold is also one of those things that, like a lot of things this year, has diverged so dramatically from the U.S. stock market. It has had, in many ways, its own crash. Now, gold tends to do well in what's called a negative real rate environment, meaning when inflation is higher than interest rates. As yields have spiked this year, we are in a positive real rate environment. Should we re-enter an environment of negative real rates where inflation is higher than interest rates, then gold probably will surprise on the upside. And I think it's also important to realize gold is very much dependent upon India. India is the largest marginal buyer of gold imports. If India is going to keep on trying to prevent gold from coming into the country, that's going to put somewhat of a ceiling as far as how high any kind of gold rebound might be.
What about emerging markets? Which are most likely to show strength going forward?
Broadly speaking, emerging markets have been horrible performers on a year-to-date basis, underperforming the S&P. By the most, it's 1998 in the absence of a 1998-like event. This is something I talk about quite often in my writings. Now, I think you really want to look mainly at the BRICS within the emerging market space, Brazil, Russia, India, and China. One, as a contrarian trade, and two, under this notion that if you believe that the developed markets are correct about the future, that the economy is set to improve given this advance in equity prices, I find it very hard to believe that the BRICS, which supply the developed markets, don't participate. So I think really those four are the areas to focus on. Maybe be a little bit more cautious with India, given some of the more government issues happening there.
Michael Gayed, Pension Partners, pleasure to have you on the show this morning. Thank you.
Thank you so much.